Welcome back to The Explainer. So, today we're jumping right into the nuts and bolts of auditing different types of undertakings. Now, if you're thinking an auditor just strolls into any given building with the exact same generic checklist, well, you're in for a bit of a surprise. Auditing, it's actually a lot more like bespoke tailoring. You really have to measure the client, understand their unique structure, and cut the cloth to fit them perfectly.
And that brings us perfectly to this core principle from our source material. Quote, "The same audit procedures cannot be blindly applied to every single audit assignment." Think about it. Because an organization's accounting methods completely mirror its nature, an auditor's real job is to adapt. They have to adapt to that specific environment to actually get a true and fair view of the financial performance.
All right, here's our roadmap for today. We're going to cover 1. The tailored audit approach. 2. Navigating regulatory frameworks. 3. Auditing educational institutions. 4. Step 1. The Constitution. 5. Step 2. Internal controls. And 6. Step 3. Minutes and budgets.
Section 1. The tailored audit approach. One size does not fit all. So, right off the bat, our sources emphasize that an auditor must adopt procedures that perfectly suit the very nature of the accounting process adopted by the organization. Just like that master tailor we talked about, you literally can't put a banking suit on a university, right? Or a hospital suit on a local municipality. The audit procedures have to be completely customized to fit the fundamental character of that specific organization.
Section 2. Navigating regulatory frameworks, the rule books.
Now, just look at how wildly the rules change across different undertakings. If you're auditing a bank in India, you are strictly bound by the Banking Regulation Act of 1949 and the RBI Act of 1934. But say you walk into a cooperative society instead. Suddenly, you have to open up the Cooperative Societies Act of 1912. And for local self-governments, like municipalities and panchayats, you're guided by the Constitution of India and various state municipalities acts. Basically, the auditor has to master the specific rule book for that exact industry before they even look at a single receipt.
Moving on to Section 3, Auditing Educational Institutions, a case study.
So, how exactly do we audit a school or a university? Well, as you might have guessed, it depends heavily on their specific legal framework. State institutions might operate under the Societies Registration Act of 1960, or maybe a State Public Trust Act. Central educational institutions, on the other hand, are guided by Ministry of Education regulations, and those massive state or central universities, they're often established by their very own special legislation.
So when an auditor walks onto a campus, they aren't just looking at, tuition fee receipts and chalk budgets. They're there to ensure the institution complies with the exact provisions of its foundational legislation or its trust deed. And as you'll see, that specific rulebook completely shapes their investigative checklist. Okay, so here is the 4-part, step-by-step roadmap laid out in the auditing guidelines. We've got 1. Understand the Constitution. 2. Assess internal control. 3. Consult the minute book. And 4. Consult the budget. Every single auditor has to follow this framework to ensure an educational institution is actually financially transparent and accountable. Which brings us to Section 4. Step 1. The Constitution.
So, Step 1. Whether it's a massive state university or just a small local public trust, the auditor absolutely must first study the foundational documents. We're talking about the trust deed, the special act, or any regulations framed under that act. Why? Well, because these documents explicitly dictate how that specific institution is legally required to maintain its accounts. I mean, you literally can't verify their compliance until you know exactly what their specific rules are.
All right, Section 5, Step 2, Internal Controls.
Normally, educational institutions have a pretty well-organized internal control system in place. But before finalizing the actual audit program, the auditor has to evaluate how the school handles its assets. Like, what exactly is the process when they acquire new laboratory equipment? How do they handle the maintenance of their campus buildings? And crucially, who actually has the authority to authorize a financial transaction? Assessing this entire internal security system tells the auditor exactly where the weak points might be hidden.
And finally, Section 6, Step 3, Minutes and Budgets.
Now, this is where it gets really interesting. An auditor here isn't just crunching numbers in a spreadsheet, they're actually doing deep reading. They have to carefully examine all the notices and minutes of the managing committee or governing body for colleges. And for universities, they're reading the minutes of the Senate, the syndicate, the court, and the council.
They're specifically looking for decisions made about bank accounts and expenditure approvals, just to ensure those decisions were actually carried out. Then they cross-reference all of this with the budget, checking the allocations to different heads to confirm that absolutely no amount sanctioned beyond the official budget was executed without the proper approval. It's real detective work.
So if your local university overspent its budget this year, do you know whose job it is to uncover those unapproved sanctions in the minute book? Yep, it's the auditor's job. And they can really only do it effectively because they didn't just bring a generic checklist. They brought a tailored approach designed specifically for the unique legal and operational framework of that exact university. I want to leave you with this thought to wrap up the explainer. Behind every well-functioning school, hospital, and local government in our communities, there is a highly specialized, tailored audit procedure working behind the scenes, ensuring that every single sanctioned dollar is accounted for. It's not just math, it's accountability.
Today, we're pulling back the curtain on something most of us have participated in, but very few of us actually get to see from the inside. We're talking about the financial machinery of colleges and universities. I mean, think about the massive, constant flow of money in an educational institution. You've got tuition fees, government grants, faculty salaries, massive campus construction projects. How do we know that every single dollar or rupee is actually accounted for? Well, that is the fascinating and honestly quite complex challenge of the institutional auditor. So today, we're going to explore the strict guidelines that ensure a school's financial integrity. Here's our roadmap for this explainer. 1. Money in, verifying receipts. 2. Money out, verifying payments. 3. Checking assets and liabilities. And 4. Grading the financial statements.
All right, let's dive right in with Section 1, Money In, Verifying Receipts.
So, I want you to think about what happens the exact moment you pay your school fees. Does it just go into some giant vault? More importantly, how does the school prove you actually paid? To answer this, we really have to put on our auditor hats and adopt a rigorous problem-solving mindset. We can't just assume the money arrived safely. We have to track its exact paper trail. To guide us through this, we're looking directly at the official study notes from the Institute of Cost Accountants of India regarding the audit of educational institutions. This is essentially our rule book for today. It lays out the exact, uncompromising steps an auditor absolutely must take to verify every single transaction on a campus. Okay, so we methodically break down the different types of fees. For tuition fees, auditors tally the counterfoils of the fee receipts right against the fee register. For admission fees, they're checking admission slips signed by the head of the institution and confirming that the amount was actually credited to a capital fund. Then you have other fees, things like library, session, development, or hostel fees. The auditor ensures these are accounted for under the appropriate heads based on their counterfoils and registers. And this is crucial. They also check that any free studentships or fee concessions were actually granted by a properly authorized person, completely in line with the prescribed rules. But what happens when things don't go perfectly to plan? Like if a student pays beyond the due date, the auditor actually checks the register to verify if the required late fine was charged and if it was properly recorded. They literally total up the various columns of the fees register for each month or term. Why? To ascertain that advance payments are carried forward and that any irrecoverable arrears have been formally written off, but only under the sanction of an appropriate authority. They also have to make sure that all collections are actually deposited into the bank account at the end of the day, and that all fee or fine arrears are fully taken into consideration at the end of the accounting period.
Of course, tuition is just one piece of the puzzle here. What about non-student revenue? The auditor verifies grants received from the government or other organizations by cross-referencing the official sanction letters with bank statements. They ensure that any donations received are properly acknowledged and recorded in the books. If the institution rents out property, the auditor checks the counterfoils of the receipts issued to the renting parties. They even vouch for the income generated from endowments, legacies, and dividends from investments. And get this, they physically inspect the securities held in respect to those investments. It is an incredibly thorough process.
All right, moving right along to Section 2, Money Out, Verifying Payments.
Let's look at what is usually the biggest expense on campus: salaries and wages paid to employees. In government or aided colleges, this is a very strict process. First, the auditor verifies claims are properly prepared. Second, they ensure the sanctioned amount was distributed to the right person, checking the calculations and the accounting for any arrear salaries. Finally, they check that deductibles, things like Provident Fund contributions and income tax deducted at source, or TDS, have been deposited with the concerned authorities right on time. And if they haven't been deposited, the auditor must verify that they are at least accounted for appropriately in the meantime.
Auditors also handle a vast array of other campus expenses. Regular bills, electricity, telephone, broadband, traveling expenses, those are vouched against available accounting records and vouchers. Special events, like a seminar or symposium, have to be matched against specific sanctioned grants or funding obtained from an organization. And for massive purchases, like constructing college buildings or buying fixed assets, they rely on available vouchers and official resolutions from the purchase or finance committee meetings. Furthermore, if the school uses specific grants to buy fixed assets, library books, or laboratory equipment, the utilization of those grants must be distinctly and separately vouched. Now, there's a really strict rule for specific investments representing endowment funds meant for student prizes. These funds must be kept strictly separate. Furthermore, if that investment generates income in excess of the actual prize amounts given out, that excess cannot just be spent on, say, electricity bills. No way. It absolutely must be accumulated and reinvested along with the original corpus.
Here we contrast two very different types of outflows. When examining operational payments for a hostel, the auditor is verifying bills for physical repairs and maintenance of the building, electricity charges, and the purchase of food items. But when looking at caution deposits refunded to students, they don't just check the receipt and accounting records. They actually must confirm that all of the students' hostel dues were fully recovered before their deposit of caution money was ever handed back to them.
Okay, let's look at Section 3, Checking Assets and Liabilities.
You might think auditing is just sitting at a desk looking at numbers on a screen, but there are actually major hands-on requirements here. The auditor must conduct a physical verification of tangible fixed assets exactly as they are shown in the fixed asset register. They must verify investments based on the investment register. They also check the inventories of a huge variety of items: furniture, stationery, clothing, provisions, and all sorts of equipment. They do this by referencing the stock register, and crucially, the values applied to these diverse physical items must be test-checked by the auditor themselves.
Of course, we know those physical assets don't hold their original value forever. That brings us to depreciation and amortization. The auditor's job is to check whether depreciation has been provided strictly as per the specific accounting policy adopted by that institution. It's really all about consistency. And while they're at it, the auditor also verifies if the institution has received the proper refund of any TDS applied to the interest on their investments, if there are any.
Next, the auditor carefully examines what the school actually owes, its liabilities. They look for outstanding utility bills like electricity and telephone. They hunt for any TDS and Provident Fund money that has not yet been deposited. But it goes beyond just checking the bills. They must ascertain that the system ordering the inspection of goods upon receipt, like foodstuffs, clothing, and equipment, is actually efficient and that all bills are duly authorized and passed before any payment is ever made.
And finally, Section 4, Grading the Financial Statements.
The official guidelines highlight the exact, uncompromising phrasing the auditor must abide by at the very end of this process. They must verify that the financial statements have been prepared in the exact form and manner specified by the regulatory authority. There is absolutely no room for creative interpretation here. It's by the book or not at all.
Because the ultimate goal of the auditor is to ensure total, absolute compliance. It is not just about making sure the math adds up at the bottom of the page. It's about ensuring that every single entry complies with established accounting standards and all applicable legal requirements governing that specific educational institution. So when you look at a university's end-of-year report, you now know exactly the gauntlet of checks those numbers went through to get there.
So, we've basically followed the educational dollar all the way from the moment a student pays their tuition fee to the moment an endowment generates interest, right through to the physical verification of campus lab equipment. It is a vast, complex, and highly regulated ecosystem. Knowing the level of microscopic scrutiny required to ensure this financial integrity, does it kind of change how you view the business of education? And more importantly, are you ready to shoulder the immense responsibility of an institutional auditor? Thanks so much for joining me for this explainer. I really hope it sparked some curiosity about the unseen systems running our world.
Today, we're tackling the audit of healthcare organizations. You can kind of think of it like acting as a financial doctor. We're carefully examining a patient to make sure they're in absolute peak condition. Healthcare organizations, primarily hospitals and nursing homes, they're incredibly unique entities, right? They exist to provide medical services to the public. And because their business processes differ so vastly from standard commercial orgs, we absolutely need a specialized approach here.
So, to understand how these vital public services survive and thrive, we really have to ask, how exactly does an auditor prepare a sound plan to examine these highly unique business processes?
Unlike your standard retail store or a manufacturing plant, a hospital deals with highly specialized equipment, unique funding streams, and complex compliance rules. This matters, folks, because we literally all rely on these facilities to be there when our families need them most. Ensuring they remain financially viable guarantees they can keep saving lives.
We're going to walk through our definitive auditing solution using a medical diagnosis approach. Our agenda covers 1. The anatomy of healthcare orgs, 2. Checking the vital signs, 3. Examining the receipts, 4. Verifying the payments, and 5. Finalizing the diagnosis. Let's get right to it.
Section 1, Anatomy of Healthcare Orgs.
Right off the bat, there is a fundamental difference in the nature of these entities. On one side, we've got non-profit-seeking organizations. This includes hospitals run and funded by the government, local authorities, or charitable trusts. On the other side, we have profit-seeking organizations, which are established by the private sector. You probably know them best as private nursing homes. This distinction, it's basically the foundation of our entire audit plan, because it totally changes how we approach their accounts and regulatory compliance.
So, the crucial point here is that our very first move, Step A, is to read the organization's financial DNA. We have to study its founding documents to really understand the rules governing its management. If it's a trust, well, we dive straight into the trust deed. If it's a partnership, we examine the partnership agreement. And for a company, it's the Articles and Memorandum of Association. By doing this, the auditor pinpoints the exact rules and regulations relating to management and the precise process for preparing their accounts.
Moving on to Section 2, Checking the Vital Signs.
These next two actions, Steps B and C, they essentially act as our stethoscope. They allow us to evaluate how well the organization maintains its assets and let us listen in on the crucial decisions made by the board of directors.
Step B is all about assessing the internal control system. By evaluating how strictly the hospital guards its assets and exactly how it approves transactions, the auditor figures out the overall scope of the audit work required. We're looking at the controls associated with acquiring and maintaining some highly expensive medical assets, plus the authorization protocols for everyday transactions. If the controls are weak, well, the audit has to be much, much more rigorous.
Then, moving to Step C, we have to carefully consult the minute book. We examine the notices and minutes from the meetings of the board of directors, managing committees, and purchase committees. We're hunting for decisions that directly affect the accounting. Basically, we need to confirm that any decisions made regarding the operation of bank accounts or the approval of major expenditures actually got complied with in practice.
Section 3. Examining the receipts.
A hospital's income is incredibly diverse to say the least. So in Step D, verifying receipts, we have to vouch for a huge array of transactions. For government hospitals, we verify grants using official orders and sanction letters. For paying patients, we cross-reference the patient admission register with the counterfoils of receipts and bills. And for all those pathological tests, we need to see the specific counterfoils of receipts and copies of the bills. Literally, every donation must be traced back to its specific counterfoil receipts.
And here's the thing. Many hospitals don't just make money from medical procedures. They might have on-site guest houses for patients' families, which require their own verification through specific registers and accounting entries. They might also earn interest and dividend income from investments. We have to vouch for those using the investment register and the actual interest and dividend warrants.
We also have to apply a critical financial check to specific funds. Let's say a donor leaves a legacy or gives a donation specifically to build, a new pediatric wing. The auditor absolutely must guarantee that those funds and any income generated from them weren't utilized for any other purposes. It's a huge compliance check.
Section 4. Verifying the payments.
So, how would you verify a visiting specialist's pay? Step E covers payment verification. As an auditor, you can't just look at a standard payroll sheet for doctors. No way. You must cross-reference their remuneration directly against the physical list of visits they made and the actual operations they performed. This ensures the hospital is only paying for the exact medical services rendered.
Beyond the doctors, we have to verify that every single piece of capital expenditure, like new medical machinery, furniture, or a new ambulance, is backed by solid documentary evidence. We're talking counterfoils, checks, invoices, and tenders. We vouch staff salaries using attendance registers and payroll, making sure to examine that the appointment and payment of casual staff are duly authorized, and we definitely can't forget the consumables.
Every pathological test kit and X-ray plate purchased must be verified against tenders, orders placed, and invoices received, right alongside standard overheads like electricity and fuel bills.
Section 5. Finalizing the diagnosis.
These final two steps, steps F and G, ensure that the underlying bone structure of the hospital is completely solid and that the final health report presented to the public and regulators is entirely accurate.
Step F is all about hard evidence. It is not enough to just look at a piece of paper. The auditor must physically verify the fixed assets and investments based on the fixed asset register and investment register. We have to carefully check the stock registers and the valuations of vital medicines, food items, and equipment. We also check the adequacy of depreciation accounting, and we collect the list of all liabilities, verifying them strictly against contracts and arrear bills.
Which brings us to the crucial point of Step G, our final step. This is about ensuring the financial statements are prepared in the exact manner and format required. Like we discussed at the very beginning, this format has to match the nature of the organization, whether it's a profit-seeking private nursing home or a nonprofit charitable trust, as well as its specific ownership structure. Everything ties right back to that foundational DNA.
Ultimately, preparing a sound audit plan isn't just about balancing books or ticking boxes on a checklist. It's the definitive checkup that ensures these incredibly crucial organizations can keep their doors open, maintain their vital equipment, pay their specialized staff, and continue serving patients in need tomorrow. So I'll leave you with this. What do you think is the biggest financial risk a modern hospital faces today? Keep that in mind as you review these audit steps.
We are putting on our financial detective hats and pulling back the curtain on one of the most dynamic, complex industries in the entire world. We're going to uncover exactly how the incredibly diverse hospitality sector gets audited. We'll be relying strictly on the official procedures to see how financial professionals actually make sense of businesses that range from your neighborhood cafe all the way up to massive travel conglomerates. Okay, so let's just dive right into the core challenge here. Think about it for a second. How exactly do you audit a local restaurant that deals in physical ingredients, daily cash registers, and actual tables, versus a global travel agency that deals almost entirely in digital bookings, commissions, and intangible services? I mean, these businesses operate in fundamentally different ways on a day-to-day basis. Yet an auditor has to step into both of them and verify that their financial statements are completely accurate. So how is that even possible? To figure that out, here is our roadmap for today. We'll start with the diverse hospitality sector, move into the universal rules of auditing, learn the language of auditing, and then get into the specifics with auditing food and beverages, followed by auditing travel and tourism. Finally, we'll wrap up with the auditor's final takeaway. Let's kick things off with Section 1, the diverse hospitality sector. Before we can even talk about procedures, we have to establish the sheer variety we're dealing with here. Our official guidelines break this sector into 4 main categories. You've got food and beverages, so restaurants, then travel and tourism. Next is lodging, like hotels and guest houses, and finally, recreation, which includes places like cinema halls and theme parks. This massive variety means auditing simply cannot be a one-size-fits-all approach. A financial detective absolutely has to adapt to the reality of selling a plate of food versus, say, selling a roller coaster ticket. Moving right along to Section 2, Universal Rules of Auditing. Now, despite all those differences, there are a few foundational steps common to all organizations. Think of this as the starting line for any auditor. Step 1 is understanding the ownership structure of the organization. Is it a sole proprietorship, a partnership, a private or public limited company? You have to know this to determine the regulatory requirements for both management and accounting. Step 2 is evaluating the internal control system. This is crucial because it dictates the nature, the timing, and the extent of all the audit procedures that will follow. And Step 3, well, it's incredibly practical. Just check that the organization actually has a valid license from the appropriate authority to run the business. Without these 3 universal structural checks, the rest of the audit literally cannot proceed. Section 3, the language of auditing. Okay, to truly grasp the specific procedures we're about to look at, we really need to decode a crucial piece of accounting jargon. And that word is vouching. When an auditor vouches for something, they aren't just taking the manager's word for it, right? Vouching is the strict process of verifying a transaction by matching it to hard documentarian evidence. We're talking about tracing a recorded sale or expense all the way back to the original order placed, an invoice, a counterfoil of a receipt, or a bank record. Knowing this definition really empowers you to understand exactly how an auditor verifies the financial paper trail. They vouch it. Which brings us to Section 4, Auditing food and beverages. When you're auditing a restaurant, you are dealing with a highly physical reality. The two major risk factors: high volume cash and perishable stock. A restaurant generates daily revenue, very often in physical cash, and its inventory literally spoils if it goes unused. So auditors have to ensure that daily cash actually hits the bank account, and they need to carefully monitor stock valuations. They are specifically looking out for large write-offs of spoiled, perishable items. Let's break down those specific restaurant procedures a bit more. Revenue and expenses form the baseline. Auditors verify that the total recognized revenue from daily and monthly sales reports actually matches the bank statements. They also vouch all those supplier payments using hard invoices, along with rent and electricity bills. But listen, they also hunt for red flags. A really deep dive into the petty cash book is absolutely crucial here. Any irregularity there is a massive warning sign that needs further examination. Finally, they cross-reference payroll with physical attendance registers, check the adequacy of depreciation, and physically verify fixed assets and liabilities against arrear bills and contracts. It is an intensely paper-heavy physical audit. Now, let's contrast that with Section 5, Auditing Travel and Tourism. Here is where the fundamental shift happens. On one side, as we just saw, restaurants have tangible, physical stock: food, beverages, cash registers. But on the other side, travel and tourism deals almost entirely with intangible inventory. We're talking tour bookings, commission revenues, cancellations. The auditor's focus has to heavily adapt because, well, you simply can't walk into a freezer to count canceled airline tickets. Because there's no physical stock, the auditor has to rely heavily on vouching the paper trail. For money coming in, they vouch customer collections against booking details and receipts, determine any end-of-year arrears, and vouch commission revenues coming in from various tour partners. For money going out, they vouch payments made for air, rail, or sea bookings, and hotel accommodations. Crucially, they have to track the constant flow of booking cancellations. They also need to verify that any discounts offered to individual customers were actually approved by a competent authority. Add in standard checks for overhead expenses, permanent staff salaries based on leave applications, and a very careful verification of incentive payments, and you have a complete picture of how to audit an intangible business. But, despite the vast differences between counting perishable tomatoes and vouching canceled flights, universal administrative overhead really ties all these diverse sectors together. Just as the source guidelines mandate for hotels, where assets must be physically verified against the fixed asset register and payroll closely reviewed, these meticulous, strict paper trails for permanent staff and long-term liabilities remain the universal anchor points of pretty much any hospitality audit. Let's wrap things up with Section 6, the auditor's final takeaway. I really want you to hear this exact quote from our official source material. It says, "Since the organizations in the above categories largely differ in their business processes, auditing procedures will certainly be different for each of them, barring a few common areas." This is the ultimate lesson for any financial detective out there. The foundational rules, like checking licenses, understanding ownership, evaluating internal controls, those remain constant. But a great auditor knows that the specific procedures must relentlessly adapt to the unique business reality of each sector. You just cannot audit a theme park the exact same way you'd audit a diner. So, knowing what you now know about the tangible physical risks of restaurants versus the intangible service complexities of travel and tourism, which hospitality sector do you think would be the absolute hardest to audit? It certainly makes you look at every hotel, restaurant, and travel agency you use in a completely new analytical light. Thank you so much for joining me on this explainer today, and keep that focused curiosity sharp.